Boom, there he is, Scott Groves. How you doing, man? Oh, hold on.
Can't hear you,
I
Scott.
was muted.
There.
Oh, there he is.
You would figure after 4 years of everybody being on Zoom and StreamYard, we would figure this out. But yeah,
Uh,
I was saying that you guys have this dialed in. Like it looks good, the production is good. You got your disclaimer. I don't know if we're live
yeah,
anywhere right now, but this is awesome.
yeah. Well, we
Cool.
try to keep it. We try to keep it in that pro amateur category. So if we do make mistakes, we can always back into the amateur part very quickly. So yeah. Um,
Perfect.
well, look, man. So I'll let Darren do the intro to Scott Groves. All I have to say is, before that, God, man, I look at your Instagram, I see your life. You're living large, man. This is just a long list of things that you do. So, and somehow you fit in mortgage lending. So, anyway, Darren, what did you have to say about this guy?
Sure. Scott, good to see you in person. Usually it's by phone.
Yeah.
But we've worked with Scott for a decade at least. I don't even know how many years. It's been a long time.
Yep.
And when you work with someone that long, there's got to be a reason. And it's because you're good looking, Scott. There's no other reason.
Thank you.
No, there are people in this business that you need to be a part of your business to help get things done. It's a business where people who can figure things out, who can listen and make people feel heard and get results, are people you need to associate yourself with. And Scott's been in that category for quite some time for us. When it comes to a mortgage loan, a lot of people simply think they don't do this very frequently. They think rate and costs to do the loan. It's so much more than that. It is about moving quickly, knowing the local agents, the local market, and making sure you get to the finish line and keep everybody involved and satisfied along the way. And Scott is a pro at doing that. So that's why we have Scott on today. And we'll let Scott lead into what he wants to talk about a little bit.
Well,
Yeah.
thanks, man.
So,
I appreciate the invite on and looking forward to talking about, the boring part of the real estate transaction, which is math and putting people in debt for 30 years.
yeah, there you go. Well, look, man, I left the title real open for you. I know you've got some things you want to talk about, but yeah, making decisions in today's market. Talk to us.
Yeah,
Introduce us.
I think something that's grabbing a lot of headlines right now on the news and just kind of in the kind of social media sphere and the
Mm-hmm.
pop culture zeitgeist, like, oh, there's no inventory, interest rates are up, et cetera, et cetera, et cetera, and people kind of know that, and maybe they're
Mm.
making really important financial decisions like, oh, I should buy, I should sell, I should upgrade, I should be a first time buyer, I should stop renting. They're making decisions based on the headlines. And what I appreciate about working with you two is you always tell anybody you meet, you're like, hey man, there's no obligation. It's not like he charges you for the conversation. Just have a conversation with Scott and get the real figures, understand the math. If you're renting in LA for $4,500 a month, you should probably be a buyer no matter
What's
what
going
the
on?
interest rate is. Do we have a little glitch
We
in
had a
the
glitch.
I think
okay,
looks
sorry.
Rewind
yours
like
looks good on my
rewind like
side,
four
Joe.
seconds. Yeah?
Yeah.
Good.
Yeah.
Yeah, we're solid. So yeah, I think just people are making a lot of what feels like rational decisions, but very important decisions based on the
Mm.
headlines. And so,
Yeah.
again, one of the things I appreciate about working with you two is you're like, hey, just talk to Scott, understand the underlying math, and then
Yeah.
make your good life defining decision of like, do I buy a house? Do I sell a house? Do
Yeah.
I upgrade? Do I downgrade?
Yeah.
And so, yeah, I think that's
Yeah.
what we're going to talk a little bit about today, just the math of it.
Yep.
Cool. Yeah,
Well, it's a,
not only for you, Scott, but for us. Sometimes people pause to have those conversations with professionals. Maybe, a concern, a commitment. And a lot of people we work with are even concerned about wasting other people's time. But we
Right.
always say, hey, man, we just want to help you get to the right place and make the right decision for you. Exactly what you're saying. So, yes, we're passing people on with the same message that we give them just to have the original conversation as well.
Yeah, and they're kind of just like a good case study in this. I was talking to a client yesterday, and by the way, these numbers for some people in certain neighborhoods might seem very high. So just divide by half or lop off a zero at the end of the conversation or whatever is relevant for your market area. But one of the things that I got a call on yesterday was like, hey Scott, we own this house, we bought 9 years ago, and we bought it for 900,000. It's worth $1,700,000. So we owe 700,000 on it. Let's sell. We'll make $1,000,000, and then we're going to go buy the forever house for 2.2 million with a pool and a additional bedroom, et cetera, et cetera, et cetera. And we'll go from there, right? And that's our plan. I'm like, okay, cool. That totally makes sense. And let's just go through the numbers, right? You have a current mortgage at 3%. When you sell, there's going to be some real estate commissions. There's going to be maybe some capital gain taxes because only that first 500,000 is tax free. Then you're going to go put probably a little bit less money down on the new house than you think, and your property taxes are going to be more expensive, and your interest rate, unfortunately, just because of just market cycles completely out of all of our control, your interest rate's going to be about double what your loan was that you took out 3 years ago when you refinanced. So, your cost to carry or your monthly payments going to go from about $5,000 a month to about $9,500 a month.
Wow.
And, I could feel the jaw drop on the other side of the phone. And they're like, oh, okay, well, maybe we need to revise. Maybe we need to be talking about taking some cash out of our house to remodel what we have. And we'll spend a couple $100,000 to go buy an investment property in a less expensive neighborhood. And so then we start to have a real financial conversation versus them just putting the wheels in motion of, okay, we're going to sell, we're going to buy. And then halfway through the transaction, after you guys have spent all of your time, you've staged the house, you've done all the marketing, they're like, oh, wait a minute. We can't afford the next house, or we don't want to afford the next house because we're worried about the writer's strike or whatever the case may be. And so I'm always shocked how many people kind of, they shop with their eyeballs, but they're not really thinking yet with their brain until we go over the math. And that's just classic consumer behavior, right? It's like I decide to go buy a new truck, and then I'm like, let's figure out what it costs. And so, that's okay when you're talking about like a $700 payment versus a $900 payment. But when it comes to the size of a house and your real estate and probably the biggest financial decision you'll ever make, you got to talk about the numbers first. And so that's I'm having a lot of conversations like that.
Yeah, and I see there are two things in that equation that really maybe people don't consider. And one is the interest rate. It's a big jump. And two, ends up being the tax base. The increase in the tax base is huge. I'll say, and I know you asked this question, Scott, if you're over 55 and going from California to California, at least you can try to transfer that tax base on some level. You'll still have to step up. But wow, you're right. A lot of people, that's a reason why we have less inventory on some level right now. That transition up is very hard for a lot of people.
Right.
Extremely.
Right. And if you think about, that one transaction, so these people probably aren't going to sell their house for $1,700,000. They're not going to buy that house for 2.2 million. There's not going to be realtors, lenders, escrow, involved in both sides of the transaction. So you start to think about, the movers, the interior designers, that kind of stuff, the amount of money that takes out of the economy by that property not changing hands. Tax revenue, because the transfer tax for the county goes away. You start thinking about like that's just one little isolated case. Repeat that, hundreds of times across a community or millions of times across a country. It does suck a lot of economic growth and transfer of money out of the system. And personally, on a micro level, I don't really care because I want the client to make the best decision for them and their family. On a macro level, I'm kind of looking at it and I'm like, okay, well, lenders and realtors and everybody else, we just got to get used to like a new normal of fewer transactions and having to have more relevant conversations with more people in order to get to the point where we do find the right person for the right home in the right scenario. Because there's millions of people who should be a homeowner who are not currently a homeowner because they're getting scared off by the headlines. And so we just got to find more of those people to talk to.
Yeah, and the reality that's great is that we get to that point early with people because, well, in reality, we don't want to waste our time, but we also don't want them to waste their time. To get to a real solution, we don't want to find out halfway through or near the end and then regret the move they've made. Again, a reason we refer to you because we just want to get to a reality, and it makes the process of buying and selling so much easier when you're starting from a really good point with good information.
For sure. For sure. What are you all seeing right now? Is there, I mean, obviously we work in a neighborhood that's very dominated by the entertainment industry. You know, we have both the Screen Actors Guild and the Writers Actors Guild on strike. What are you
Yeah.
seeing as far as like the attitude or the anxiety out there maybe? Is it there, or are people just like, hey, this is kind of just what we do when we work in a temperamental, self-employed industry like the entertainment industry?
It's there. I think we've seen some people take a step in, and then, as Joe was mentioning, the one client just take a step back if they're directly impacted. But even people in the sphere of the entertainment industry, which is a big part of Los Angeles,
Right.
are they might get some information and just choose to pause. I mean,
Hmm.
that's the description of the real estate market, maybe in the last year.
Yeah.
A live stream called a game of chicken. Somebody just
Right.
waiting for somebody else to break. Are sellers going to concede? Price is going to go down, or buyers going to decide just to jump in? They're both still just pausing. So that's what
Yeah.
we see more than anything.
Yeah. One of my biggest pet peeves, and I appreciate realtors like you who are doing live streams like this to talk about the reality on the ground. You know, I'll talk to clients at jujitsu or at the kids' soccer game or family friends, and they're like, "Oh well, am I going to get to buy some real estate when the crash comes?" And I'm like, "Hey, you can believe whatever you want to believe about the market and politics and et cetera, et cetera, et cetera. But the bottom line is there are millions of new household formations. So couples, people having kids, people graduating college, all the life events that lead people to buy a house. There are millions more first time buyers than there are available properties on the market. So yeah, prices affect things, interest rate affect things. But the bottom line is when you have people that need places to live, they're going to buy houses. And so, I understand the consumer sentiment of they're like, oh, prices have to come down because interest rates are higher and, maybe the economy is doing X, Y, Z. It's like, no, they don't, because this is just going back to Econ 101, supply and demand. There's way
Right.
more demand than there is supply. So the available houses, even if there's fewer of them, they're still going to be more expensive. So I kind of, I try to educate people a little bit, and then I just kind of shut my mouth because I don't feel like I should be preaching to people or giving them a dissertation. But those people that are sitting on the sidelines, many of them sitting on the sidelines since 2012, saying, "Oh,
We
well,
have
I'm just
some of
going to
those.
wait. I'm just going to wait
Yeah.
for the crash to buy." It's like, well, if you didn't buy in Eagle Rock, Highland Park, Echo Park, Atwater Village,
Yeah.
Los Feliz in 2012, 2014, 2015, you've lost out on like $1 million of appreciation. And if you continue to sit on the sidelines, you'll probably miss out on a couple $100,000 more of appreciation. And that's just demographics. That's not my opinion on like the market. That's just there's too many people out there that have to buy a house.
Yeah, and when you're in the
Yeah.
communities that we serve, the only increase in inventory you're talking about is some infill, and there's limited space to do infill. We're not in the suburbs where you're building out into open land,
Right.
which has
Right.
and infill is high end stuff. Nobody's doing infill with low grade,
Affordable housing. Yeah.
yeah, affordable housing components at all, unless they're for rent. Those do exist.
Right. Right.
So yeah, I mean, I think I saw this morning predictions for the future, a couple percent increase over the next couple years into 2026, still on the real estate side on value. So
Yeah. And even some of that urban sprawl that we're seeing way farther north in like Valencia, where I'm at, they're building miles past and behind Magic Mountain. Starter home,
Yeah.
they're still going to be $1 million. So
yeah,
it's not like you save some huge premium by giving yourself an hour long commute. So, let's talk about the numbers, get with Joe and Darren about, what you can find and just, yeah, it's like that old saying, right? The best time to plant a tree was yesterday. The second best time was today. It's like, yeah, of course you should have bought a house in 2014. I wish I would have bought 10 of them. But the next
Yeah.
best time to buy a house is today because they're not getting cheaper. You need a place to live and you might as well take advantage of the tax write off.
and what's your thought? I often say inflation, like owning a home hedge against inflation. Inflation rising actually stabilizes housing prices, in my opinion. What's your opinion on that, Scott?
Yeah, I mean, two good things, right? Any durable asset, whether it's art, property, gold, silver, whatever, any durable asset that is tangible is going to be a good hedge against assets. And the problem that we have is you can take like the last, I don't know, 17 recessions. And in the last 17 recessions, housing actually did really well because people get scared. Money comes out of the stock market. They buy property. They buy investment properties. It keeps prices high. The problem is we have the one outlier, which is 2007, 2008, where it was the housing market and the bad lending practices that caused the recession. So everybody looks at that one kind of at bat and they're like, oh my God, I can't buy a house because if there's a recession or if there's a lot of inflation, housing's going to go down. It's like, yeah, but the other 9 times at bat, housing hit like a double or a triple or a home run. You're just isolating that 1 out of 10 at bats where, yeah, things went wrong across the board. But in general, inflation is going to do well for housing prices historically. And then number 2, as inflation starts to come back down, inflation and interest rates are almost, they're more than correlated. There's a causation there. So what's funny is like, as inflation goes up, you're going to see a rise in property values. And then you've kind of set a new watermark for property. And then inflation comes down, mortgage interest rates come down. So then you have a refinance opportunity. Now, let's be clear, in our collective lifetime, maybe the lifetime of Joe and I, our kids, we will probably never see a mortgage again at 2.75%. That was a weird convergence of events and all the government's printing money and COVID and all the craziness. So like everybody can just put that out of their mind. Seeing a mortgage interest rate with a 2 in front of it, probably with a 3 in front of it, probably never going to happen again in our lifetimes. But it shouldn't be at 7. Like it probably should have never been as low as 2.75, but it shouldn't currently be as high as 7. That's just an impact from inflation. So I think, housing does pretty well the next couple of years. At some point within the next year to 5 years, if you did take out a mortgage, you'll be able to refinance as inflation comes down and mortgage rates come down. And so you'll kind of win both ways, right? You'll get some of the upside of the property value, and then eventually you'll be able to get the downside of financing that money at a cheaper cost. I really dislike the lenders that I feel are being a little disingenuous the last 18 months. Be like, yeah, no problem. You can refinance in 90 days. It's like, no, rates don't move that quickly. But there will be a cyclical opportunity to refinance at some point in the next year to 5 years.
Right.
Yeah, I think in my lifetime of home ownership, which goes all the way back to 94, rates have been between 8 and 2 in the low 2s. Yeah, and more probably right in that 5 to 6 range is the sweet spot.
Yeah, I think the historical average is like 7.25 or something like that. We're just super biased and super like jaded because our recency bias is from the last couple of years when it was the lowest cost to borrow money in the history of banking. Not like the history of housing in the US, not the history of like America, in the history of all banking. As far back as we can record to like the Romans, it was never cheaper than like 2.5% to borrow money. And somehow that just happened in the last 5 years. So everybody's just got to put that out of their mind.
Yeah. Short-term memory.
It's taken a while to squeeze that one out of the brain space there, man.
Right. I mean, in my mind, I'm still 165 pounds, but it hasn't been like that for 23 years.
Hey, man, just on a side note, I saw that before after on Instagram. Good job.
Yeah. Finally down a little bit, but I won't ever see 165 in my lifetime, so we'll be fine.
Cool. Well, I think that's it.
Yeah, man.
Scott, you have anything else you want to get out before we move on?
No, I would just say it's never too early to start the conversation. I know you guys feel the same way. Like if you're thinking about buying or selling today or a year from now, like start the conversation, right? Start to get the real data from professionals like Darren and Joe and understand what's going on with your house and the house you might want. And then, I've got somebody that got pre-approved today who said, realistically, I'm probably not buying until Q1 2024. I'm like, perfect. Now's the time to start. We'll check your credit. We'll make sure your income's in order. We'll give you some tips to put yourself in the best spot. So the earlier we can start that conversation, the better. And hey, if we find somebody on Friday who needs to buy a house on Saturday, we can work quickly to do that too.
Cool, man.
Yeah.
All right.
Hey, so you know what, Darren? I was thinking since we're about to go into it, maybe he could make some comments on our little mortgage rate watch. I don't know. We'll
sure.
Just keep,
open it up.
And then he can close out. Yeah.
Yeah,
Hold
sure.
on, man. So every week we do this, and Let's see here, guys. Hold on.
We opened up, Scott, Mortgage News Daily. It's
the
national
best.
Rates. Yeah, it just shows
Alright.
the trends. Very easy to follow. Good graphs.
Yeah. And by the way, a lot of people don't know this. I think you guys do
Huh.
because you're actual professionals. Mortgage News Daily is like one of the only websites on the entire internet that shows mortgage rates that only markets to loan officers. They don't sell consumer data. So you get the real answer here. You don't get some
Oh.
BS advertisement with low rates where they're trying to get people to call for a mortgage.
Right.
Mortgage,
Right.
MBS Live
is-
only sells products to loan officers. So this is the most accurate snapshot
real.
you're going to get. Kudos to you guys for using the real.
Yep.
Cool, man. Well, I didn't even
So
know
here
that.
we are. It's at least as of today, right now, we're at 7% on a 30-year fix. And
That sounds
you can
about
see
right.
the graph there. Yeah. We had that high, what was that, 7.22, somewhere around 7.6 a couple weeks ago. But, and then as we look at, and then what's the, some ups, some downs. And then we usually go over to mortgage rates and just look at everything. Let's see here. Yeah. So 15-year fix, 6.37, 30-year jumbo, 6.98, 5-1, ARM, 6.95, 30-year FHA, 6.6, and then 30-year VA, 6.59.
Scott,
And,
what has brought the jumbo and the traditional loan closer again? There was a little more of a gap for a long time.
Yeah, it's really interesting. So jumbo loans, and this is depending on what county you're in, but let's just, for rounding errors, we'll call jumbo loans a loan over $1 million.
Sure.
Those loans are financed and they're on the balance sheet of individual banks. So when you do a conventional loan, a loan under $1 million, the interest rate is set by the lender, but your loan really ends up getting sold to Fannie Mae or Freddie Mac, a big government entity. On jumbo loans over $1 million, Chase, Bank of America, Citibank, some big hedge funds, they're playing with their own cash. They have to put their own money aside for this. So what happens is, it's really kind of just random, is the jumbo lenders, the banks, will decide at certain times, hey, we're comfortable kind of beating the market and being under the conventional rates because we want to bring in new money, we want to bring in consumers, we have a lot of money to lend out. But in times when interest rates are kind of in flux, sometimes they'll be more expensive or right on par. So right now, the banks are just trying to balance their balance sheet where what's the money that we're bringing in that we can pay an interest rate on to savers? And then how can we send that money out the back door to borrowers? And they're constantly trying to fine tune that and just balance that sheet. So like if they're having deposits leave because it's, there's better cash flow and interest rates elsewhere, then their rates will go up because they want to slow down the flow of incoming loans. If all of a sudden you see jumbo loans drop dramatically, that probably means they took an influx of cash in money market accounts and savings and bonds, and they need to lend that money out. So people think there's some magic formula, and it's like, no, it's really just the banks trying to balance their own balance sheet and decide, do we need to lend money or do we need to slow down the money that we're lending out? So yeah, it's kind of silly. So right now the banks are just trying to balance with whatever the government is offering.
One last quick thing. What's your expectation for, I believe the Fed meets next week? What do you believe will happen?
I think they will finally realize, because, what's his name? Wayne Gretzky used to say, like, good players skate to where the puck is. Great players skate to where the puck's going to be. And the Fed is good. They're always measuring, like, where are we at now? And I think they're finally going to see, like, oh, inflation's on its way down. Spending is kind of getting under control. We have some more stability. I think they will say that they're more or less done raising interest rates and that the damage has been done. Like they raised interest rates to slow down the economy and they can chill out a little bit. But the Federal Reserve, I mean, the guy who runs the Federal Reserve is not an economist. He was like a trial lawyer. So, I'm always just assuming they're going to screw up. But I think the data is finally there that they're not just going to keep swinging the pendulum farther back and forth than they need to be. I think they will slow down and stop cutting rates here, either this meeting or the next one.
Well, you heard it. Next Thursday, we'll give the data and see how.
Yeah, we'll see if Scott's crystal ball was right.
Yeah. Well, that was very hopeful. We're not as hopeful. That's great, man.
Cool. Thank you, Scott. Really appreciate
All right.
it, man.
We'll talk to you soon. Thank you.
Take care. Bye. See you now. All right. Well, that's real fun when we have a guest. I like that.
Yeah. Particularly one who can flow into various topics with us. Scott's a
Yeah.
super smart guy, understands
Yeah.
the economy, understands the dynamics of the economy, how they interact, and he shares that with the clients so that they can, as we said, make good decisions.
Yeah. Yeah. Well, that's awesome.